Welcome to the Pro Ticker Deep Dive. Today, we're opening up a file that really describes what's arguably one of the most complex, maybe even dangerous economic situations investors have faced in, well, maybe 2 decades. Our mission here is to unpack what some are calling a dangerous cocktail of three crises that seem to be converging, all threatening market stability. We're talking sticky inflation, ballooning national debt, and frankly, extreme equity valuation.
It really is a perfect storm brewing on the macro level. And what makes this deep dive so essential right now is this profound disconnect we're seeing. On one side, you got the S&P 500 surging, 16% this year, riding high, mostly on AI excitement.
Yeah, that AI narrative is powerful.
It is. But then on the other hand, the underlying economic foundations, the things that actually guarantee long-term stability, well, they seem to be cracking. Pretty alarming, actually.
And that's the core tension, right? That's what we need to figure out for you, the listener. Is the stock market just, cruising for a bruising, set up for an inevitable, maybe brutal collapse? Or is all this worry about the big numbers maybe a bit misplaced?
Based on the analysis we've seen, the risk of a, let's say, significant correction looks exceptionally high.
Why so high? What's the core reason?
Well, it seems to be structural. The very policy tools you'd normally use to solve one problem, like slowing the economy down to cool prices.
Right, the Fed raising rates.
Exactly. Those tools are actively making the other two problems, the debt and those high valuations, worse. It basically forces the Federal Reserve into what looks like an impossible choice.
Damned if they do, damned if they don't.
Pretty much. Either keep rates higher for longer, which risks triggering a really severe recession, or, cut rates too soon and risk reigniting the very inflation they spent the last 2 years trying desperately to control.
Okay, let's break down this trilogy of risk then. Starting with the one that's been, well, the most immediate and stubborn headache. Sticky inflation. We came into 2025 thinking, okay, inflation will probably stabilize, drift back towards that 2% target the Fed wants, right? Supply chains sorting themselves out.
That was the hope. That whole scenario just hasn't played out, and it hasn't just been delayed. Inflation seems to have found a new kind of dangerous plateau. If you look at the data through, say, August 2025, headline PCE inflation was still at 2.7%.
And core PCE, the Fed's preferred one.
Still sticky, held stubbornly at 2.9%. That strips out the volatile food and energy, remember.
So 2.9%, that's not just a rounding error. It's nearly a full percentage point above where the Fed wants it to be. What's keeping it so high?
You really need to look inside the numbers at the composition. Services inflation, that's the big one. It's heavily tied to labor costs, wages.
People needing raises to keep up.
Exactly. And they're getting them to protect their real incomes. So services inflation just doesn't cool down as fast as, say, goods prices. And this isn't just a U.S. thing either. Globally, OECD headline inflation is holding around 4.2%. It's just proven much tougher than central banks thought.
Okay, but here's something interesting, maybe even surprising, that the analysis points to. An invisible accelerant: tariffs.
Ah, yes.
We're talking duties, sometimes as high as 25%, on a whole range of imports. And these costs, they don't always show up neatly in standard inflation models, but they absolutely hit consumers' wallets.
They absolutely do, and the impact cascades. We're hearing from companies that these tariff-related logistics costs are jumping 10%, maybe 15%. Analysts are now expecting this to push goods inflation to over 3.5%, and some sectors think apparel, electronics, things like that.
And it's not just the direct cost, is it?
No, that's the really fascinating part. Tariff-driven inflation works through expectations. If businesses think they're going to pay higher import costs down the line,
They price it in now.
they bake it into contracts today. It becomes this self-fulfilling prophecy that helps anchor inflation expectations higher, making the Fed's job even harder.
Okay, so if the Fed needs these high rates to fight this sticky, maybe tariff-fueled inflation, what's that doing to the second pillar of this crisis, the accelerating sovereign debt? I mean, the U.S. national debt just blew past $38 trillion.
That number, $38 trillion, it's almost impossible to really wrap your head around. But the analysis gives a pretty stark comparison. That debt is basically the same size as the combined economic output, the total GDP of China, India, Japan, Germany, and the UK. Altogether,
Wow.
our debt-to-GDP ratio right now, about 124.3%, and it's projected to hit nearly 127% by 2026. That kind of trajectory, well, it's fundamentally unsustainable, especially if economic growth starts to slow down.
The total debt is one thing, but the immediate pain, the thing hitting the budget now, is the cost of servicing that debt, right? Especially with rates high and old, cheap debt needing refinancing.
That is the absolute crucial point. Interest payments alone, just interest, costs $1.21 trillion in 2025. Let that sink in for you, the listener. That's 17% of all federal spending. Nearly $1 in every 5 the government spent wasn't for the military or Medicare or roads.
Oh.
It just went to pay interest on past borrowing.
And projections show that getting worse.
Oh, yeah. The CBO thinks debt service costs could reach $1.4 trillion within a decade. And looking further out, the long-term picture is, frankly, quite chilling.
How chilling.
Projections show the debt potentially hitting 200% of GDP by 2047. That's a massive threshold. If you're, say, a 50-year-old investor listening today, that debt trajectory is squarely within your investment horizon. It fundamentally changes the game for long-term assets like treasuries.
Which brings us right back to that vicious feedback loop you mentioned, the link between debt and inflation. High rates fight inflation.
But they surge the government's borrowing costs.
And the government can't just stop paying for Medicare or Social Security.
Right, so they're forced into more deficit spending just to maintain essential services, which, ironically, pumps more money back into the already inflated economy.
It's like trying to put out a fire with gasoline.
It's a truly self-defeating spiral. And that dynamic, that leads us straight into the third pillar, the risk of stagflation. Specifically, what some sources are calling stagflation light.
Define that for us.
It's this nasty condition where economic growth basically stalls or even shrinks a bit. Unemployment starts creeping up, but inflation just stays painfully high persistent.
And we're seeing signs of that potential in the labor market, aren't we? There's this weird divergence between market euphoria and what's actually happening with jobs.
A very meaningful divergence. While the S&P was rallying, the job market data showed serious deterioration under the surface. We just had the largest downward revision in 20 years.
Right, I saw that. How big was it?
The economy added 911,000 fewer jobs than they initially reported for the year ending March 2025. That's a huge revision, a massive reassessment of how strong things really were.
And it's continued since then.
That sluggishness seems to be persisting. Job creation in August was pretty weak, and unemployment ticked up to 4.3%. So when job growth is weak, but prices are still rising, that's the classic recipe, the precursor for a stagflation risk.
And meanwhile, the bond market seems to be screaming warnings about this exact scenario. The canary in the coal mine, as they say.
That's right. Look at the yield curve. The gap between the 2-year and 10-year Treasury yields, it's widening or steepening out to maybe 60, 65 basis points.
Okay, for listeners not glued to bond charts, what does that steepening usually signal?
Well, traditionally it signals two things, often at the same time. Either growing fears of a recession that happens as longer-term growth expectations fade, or it signals that investors have really deep-seated inflation expectations and are demanding a bigger risk premium for holding long-term debt.
So they want higher yields for the long haul because they maybe don't trust the Fed to hit that 2% target, and they know the government's going to keep flooding the market with new debt to cover deficits.
Precisely. Long-term yields face this structural upward pressure from just the sheer volume of Treasury issuance needed to finance those exploding deficits we talked about. They're worried about getting paid back with, cheaper dollars down the road, inflation risk.
Okay, so summing up so far, inflation is sticky, debt's running wild, the labor market looks softer than the headlines suggest, yet the equity market surged 16%. Let's pivot to the market symptoms themselves. Valuations look extreme, driven almost entirely by that mega cap tech and AI hype.
Yeah, to really gauge how extreme, you have to look beyond the simple PE. Look at the KPE ratio, the cyclically adjusted price-to-earnings ratio. It smooths out earnings over 10 years to give a better long-term picture.
And where is that now?
As of October 2025, it hit 39.5.
39.5, that number, that sounds familiar, isn't that?
Chillingly familiar. It exactly matches the peak recorded in September 2000, right before the dot-com bubble really burst.
Wow. So this level is incredibly rare territory then?
Extremely rare. In the entire 68-year history of the S&P 500, the KPE ratio has been above 39 for fewer than 22 months. Total. It signals incredible investor optimism, maybe bordering on euphoria, but history tells us that kind of optimism is rarely rewarded in the medium term.
And history gives us a pretty stark warning about what happens next, doesn't it? What were the average returns after hitting that kind of KP level before?
Yeah, the historical data is sobering. When the KPE ratio got above 39 previously, the average return over the next 3 years was a painful negative 30%, and the worst-case scenario within that average was down 43%. Meanwhile, even the simpler traditional PE ratio is hovering near 30. That's almost 50% above its long-term historical average of around 20.
Are there other warning signs in the market's technicals?
Yes, we're seeing technical signals that seem to confirm the structural overvaluation. Market breadth, for instance, is deteriorating, meaning the gains are becoming really narrow. The equal weight S&P 500, where every stock gets the same influence, not just the giants, has basically stalled out. The entire market's rise is concentrated in a shrinking handful of mega-cap tech stocks.
That sounds like a classic warning pattern.
It is. It often precedes broader market corrections. The money is essentially flowing out of the vast majority of stocks, the 490, and piling into just a magnificent few. Volume profiles also suggest rallies are happening on relatively weak conviction.
Okay, now we need to be balanced here. There is a bull case, right? An argument that maybe these problems get resolved and the valuations are justified.
Absolutely, you have to consider it. The bull argument really hinges on the idea that AI productivity gains are genuinely transformational, like a generational shift, justifying these extraordinary multiples on big tech. They'd also point to high corporate cash flows, providing a buffer against a slowdown, and crucially, they assume the tariff issues will eventually get resolved politically, which would ease some of that supply chain inflation. It's basically a bet that future growth will be strong enough to validate today's prices.
But weighing that against the data we've just discussed, the sticky inflation, the debt spiral, the weakening job market, the bear case, seems, well, arguably more plausible right now.
Based purely on the current data trends, it does seem more probable. The bear scenario is pretty straightforward. Persistent inflation forces the Fed to keep rates higher for longer than the market wants. That eventually triggers a sharper economic slowdown, maybe a full recession. Then, corporate earnings disappoint significantly. Margins get squeezed by those tariffs, by high wages, and by slowing consumer demand.
And the end result of that is the full-blown stagflation trap we mentioned earlier. What does that actually mean for your investments, for the listener's portfolio?
It likely means negative real returns across many asset classes. After accounting for inflation, cash might barely keep your head above water, if that. Bonds are currently priced, assuming inflation moderates quite nicely and sustainably. That's a big if. And equities, starting from a PE near 30, a CAPE near 40. They offer very limited upside potential compared to the substantial downside risk. You're essentially betting against decades of historical valuation patterns.
So the path forward is uncertain. What are the key things, the catalysts, that will determine which way we go over the next year or so? The analysis highlights 4 specific events everyone needs to watch.
Yeah, 4 crucial signposts. First, that December 2025 Fed decision. Will they blink and cut rates despite inflation still being well above target? Or will they hold the line, pause, and risk tightening financial conditions further, possibly triggering some kind of credit event?
That's huge. What's second?
Second, keep a very close eye on tariff resolution or escalation. Every month that goes by without clarity just prolongs the uncertainty for supply chains and keeps those inflation expectations elevated. A resolution could ease pressure. Escalation would make things much worse.
Third.
Third, the political dimension. The debt ceiling. Will we see another crisis, another game of chicken, or will there be a deal? Any political impasse that even threatens the timely payment of U.S. debt service would send shockwaves through financial markets, potentially dwarfing the other concerns.
And finally, number 4.
Finally, Q4 2025 corporate earnings guidance. This is where the rubber really meets the road for companies. Are they managing to maintain profit margins despite all these cost pressures? Or is slowing demand finally starting to bite? What companies say about the future, their guidance, will be the ultimate tell on the health of the economy outside of the AI boom.
Okay, so wrapping this up, the final word seems to be about recognizing this deceptive inflection point we're at.
Exactly. The equity market looks strong on the surface, right? Up 16%, tech stocks flying high. But you lift the hood, and almost every single structural warning light is flashing red. Sticky inflation, exploding debt, extreme valuations. It's a very unusual and potentially dangerous combination.
So the crucial part for our listeners, what does this all mean for you? What's the practical playbook for navigating this potential minefield? The analysis suggests a few key actions.
First and foremost, ruthlessly audit your current portfolio construction today, not tomorrow. Ask yourself honestly, how much equity exposure can you really tolerate if the market experiences, say, a 30% drawdown? If the thought keeps you up at night, you're probably overweight equities.
Okay, so reduce exposure to your true tolerance level. What else?
Second, rotate towards quality within your equity allocation. In environments like this, high inflation, potentially slowing growth, you want to look for businesses that pay dividends, have strong balance sheets, and crucially have demonstrated pricing power. Companies that can actually pass on rising costs.
Makes sense. And third,
Third, build some dry powder. Have cash reserves ready. Why? because periods of high fear and market stress, while painful, inevitably create opportunities. A forced rebalancing in the market will likely present chances to buy quality assets at much better prices, but only if you have the cash ready to deploy.
Right. So the core message isn't necessarily if a correction happens with valuations this stretched. History and the models suggest it's highly probable.
The essential question is different. Is your portfolio positioned not just to survive it intact, but potentially even benefit from the rebalancing that inevitably follows?
Shifting from just worrying to actively preparing.
That mindset shift from worry to preparation is probably the most essential takeaway for navigating the months ahead.
See you all in the next Pro Ticker Deep Dive.